Welcome aboard. Walter here from Naked Forex. And we're going to talk today about a pretty famous risk rule that a lot of you have maybe heard of in the past. I'll tell you a quick story. So when I was I went to school, I did a degree in psychology, and then I did a PhD in psychology after that. And the school I went to had a really big psychology program. And they let us even take master's level courses, which helped, I think, for me to get into graduate school. But my friend and I, because we weren't that far from Vegas, where we were at, it takes about 6-7 hours to get there. We would often go there. And my friend also was studying statistics and psychology, all the things that I was doing. And he wanted to win at blackjack. So he would carry around these decks of blackjack cards. He would play them all the time, right? And he was trying to figure out if he bet blackjack and he would double. By the way, if you want a free course on how to grow your account 3 different ways quickly, go to nakedtradingclass.com. The link is above or below this video. I don't want to forget to tell you that. So that nakedtradingclass.com if you want to get the 3 methods for growing an account. So he would play blackjack against himself all the time, right? And he was trying to figure out if he doubled his bet after every loss, would he make it back? And he had worked out, because they have table limits and stuff like that in Vegas. This is why they have table limits, by the way. One of the reasons why. What it meant was that he couldn't really get beyond like 9 to 12 different losses. If you got about 9 losses or maybe 12 losses, depending on where you start and what the minimum of the table is, he wouldn't, like, that's it, you're busted, you lose all your money, basically. And so we took this idea to our stat professor and said, hey, what do you think about this? What if we just, doubled our bet after every loss? He goes, are you serious? That's the gambler's fallacy. Like, what? We didn't know. He's like, oh yeah, right. It's kind of embarrassing, it's a known cognitive bias, in psychology. And so we said, okay, yeah, you're right. And that's a martingale strategy. And if you've been around trading for any length of time, you know that there are traders who will test and trade a martingale strategy. And here's why it doesn't work. I'm going to share with you my screen so you can see. But basically, you got to be careful what you're doing here. You got to be very careful. All right. So what I've got here is my fancy schmancy risk calculator at fxjake.com/risk. And what I really want to know, there's a video here that shows you how to use it and all that. What I really want to know here is, am I going to get am I going to have a bad sequence of trades? Am I going to lose a lot with my strategy? So let's say I have a 50% win rate, and I get it doesn't really matter what number I put in here because I'm not really interested in this, but I'm going to put 1%. You know what? I'm just going to put 1 right here. Well, let's say that we get paid out a little bit more. So we'll go 1.5, right? And then the question is, if I have 10,000 trades, what's the risk? What's the likelihood that I'm going to have a drawdown of, say, 11%? Okay. So what this is saying is, I have a 50% win rate, a 1.5 reward risk ratio. I'm risking 1% per trade over the next 10,000 trades. Will I draw down 11%? And the answer, of course, is yes. Now, why is that important? Well, the reason why that's important is because I know if I'm risking 1% and I keep doubling, if I risk 1% and I lose 1%, and then on my next trade, I'll risk 1% plus the amount I lost. If I lose again on the third trade, I'll risk everything I lost plus 1% to get, to make it all back. If I keep doing that, how many can I actually have in a row? And the answer is I could have 11 in a row. I could probably even have 15 in a row. 15 losers, yes. it's very likely that's going to happen. So you have to be very careful with this stuff because it seems like a good idea and it isn't a good idea, except in one instance. There's one time when martingale or martingale elements make sense. And I do know traders that use it. I do think it's dangerous, obviously, because we underestimate the likelihood of having a losing streak like that. And you can test to see how likely that is. But here, using the risk calculator. But here's the thing. If your trades actually show dependency, then all bets are off. It totally changes. What is dependency? You can look it up. But dependency is this idea, and you can test for this. If I have a winner, is the next trade more likely or less likely to be a winner? That's dependency. If the win rate stays the same for every single trade, which is what we usually assume in trading, then martingale will blow you up. If, however, there is dependency, in other words, a winner is more likely to follow a winner and a loser is more likely to follow a loser, then adjusting the amount at risk does make mathematical sense. Didn't say it makes psychological sense. It could be difficult to withstand those drawdowns that come up if you do that. But this is true. This is a mathematical truth. Just as it is true that if you use something like Optimal F, you're gonna grow an account quickly. You're also likely to blow it up, but that's the way to really push the pedal to the metal, so to speak. I don't really recommend any brokers. I'm not in that game, guys. I think I mentioned this before. Sorry. Yeah. So broker is not something that you want to see. Here's the thing. So what happens is brokers come to people like me and they say, hey, recommend us and we'll pay you. You get paid on every trade that the people make when they open up an account under you. And I'm like, no, I don't really want to do that. I like to be able to be independent. Like there's brokers that I've worked with in the past that I really liked, and then they get sold and new people take over, and then I don't like them so much anymore. All brokers are going to slip you, right? The question is, what are you going to do to get away from that? What can you do? Well, you can trade higher time frames. If you're using exit EAs like I use, then what you might do is make sure that they're not obvious to your broker. You can also download a fresh copy of MetaTrader that's not directly from your broker, like a generic version of MetaTrader, because brokers can buy add-ons and things like that to affect your trade. So if that's the game that you're going to play and you're going to worry about that, then there are lots of things that you can do, right? So that's what I would do, those sorts of things. All right, guys, you can get it at nakedtradingclass.com. That's where the course is on 3 ways to grow your account quickly. Probably one of those is going to make sense to you. I hope it helps. I wish you happy trading, and we'll see you soon. Bye.